In 1999, Warren Buffett, the US's most successful investor, said you have to be wildly optimistic to believe that corporate profits as a percent of GDP can, for any sustained period, hold much above 6%. This chart from Charlie Biello indeed shows that statement to have long been true, until now. The last time corporate profits fell below the 6% mark was during the 2008 financial crash, also known as the Great Recession. This has people wondering, was Buffett wrong for once? 17 years is certainly a sustained period, and when you take away the very brief dip below 6% in 2008 or thereabouts, the time is actually approaching a quarter of a century, starting after the dot-com tech stocks bubble crash. That doesn't mean this staggering upward climb can continue indefinitely. The chart reflects the ebb and flow of the class struggle over the past century, and history's class struggle, of course, is not yet over. Corporate profits were high in the wake of World War II as the rebuild generated new profitable opportunities. Wartime inventions, the costs of which were largely paid for by the state, were commercialized for the civilian consumer market. Public infrastructure was often publicly owned and state-funded, again lowering the burden on capital and widening profit rates. New profitability crises arose though, arising from expanding and increasingly automated production that naturally devalues commodities and subsequently capital, compelling capitalists to attack wages and increasingly privatize state infrastructure and public funds. High demand for labour during the post-war boom had put the labour movement in a strong position though, and unions took some beating. Falling profitability was often compounded by working class resistance and productivity lost to strikes. Corporate profits as a share of GDP were noticeably low during the 1980s, but capital's rising aggression eventually won out and paid off. After the dot-com crash, profits surged to new highs, with the same happening again after the financial crash and after the pandemic and lockdowns, without ever falling below 9%. Buffett might have been proven wrong technically, and he admits he did not foresee the rise of tech corporations that operate with little outlay in fixed tangible assets, making for wider profit margins. But that is only half the story. The chart and others like it, showing corporate profits rising to record highs, disguise how increasingly desperate the ruling capitalist class has been to stave off a repeat of 2008, since when the US has had only 2 or 3 very brief economic contractions. Corporate profits have been increasingly dependent on the centralization of wealth via privatization, inflation, falling real wages, debt and public subsidies, including from income and consumption taxes. The chart does not tell the story that the average lifespan of US companies on the stock market has plummeted, or that the overall number of companies has actually halved since around the turn of the century as a result of bankruptcies and mergers, again driven by the devaluation of capital inherent to expanding and accelerating commodity production. As the AI and automation revolutions continue, driven by capital's need for higher accumulation and productivity, these trends will tend to intensify, and the capitalist class will bleed their worker and consumer bases dry, destroying the foundation of its own existence, leaving the husk of capitalism ever more dependent on an increasingly unfundable state. Corporations are flying high, all right, but like a heroin addict, chasing a bigger and bigger hit and exhausting their supply before crashing to rock bottom.